right? So rent vesting basically means that it is a smart way to build wealth, right? So rent vesting basically means that you are renting where you want to live based on your lifestyle and needs, and then continue to invest where it makes financial sense, right? So you are separating the emotions from the analytical mind here, right? So, and there could be separate reasons for that, right? So say for example, if you're living in a very premium suburb which is very expensive today to buy, and you are probably not even able to afford, or you can probably buy but you think the repayments are going to be quite high and will impact your lifestyle. So rent vesting could be a good way for you, right? So we'll discuss now in depth on how rent investing basically helps. But before we get into that, we'll talk about the presenters. So it's going to be me and Deepak. So I'll briefly touch upon who I am, what I've done, and what I do at the moment, right? So a bit of my background before I get into who I am, what I'm doing today. So I moved to Australia in 2017 after a decade working in IT in India, right? So again, driven by my goals of building a better lifestyle. But again, in 2022, when I was working in my combank, when I completed 5 years in the country, I met a car crash. And that has actually been a life-changing moment for me, which is like I'm doing this webinar because of that. I am a founder of a buyer's agency called InvestorAid, and it was founded as an outcome of that car crash. If that would have never have happened, then I would have still been stuck in my 9 to 5 doing exactly the same thing which I probably didn't enjoy. Right. So, and regarding my portfolio, so while I was working in my 9 to 5, I bought my first property in 2019. I bought a portfolio of 8 properties before I met this car crash. And after that, the last 4 recent purchases were done in the last 12 months or so. And the most recent purchase, which is 12th purchase, has just settled today. So my combined portfolio value is sitting between 12.5 to 13 mil. By the end of the year, it should easily be touching 13 mil because of multiple reasons. First thing, all these properties that I have invested in are invested in good markets based on market cycle timing. So all these properties are moving up in value. So the portfolio value always keeps shifting. And also one of the properties that I own at the moment is a subdivision site where the subdivision is in final stages. So that should also help in value uplift. So yeah, and so I've been running this buyer's agency since November 2022. So we are completing 3 years by the end of this year. So I've appeared in some of the news articles. I've appeared on several podcasts. So I've recently appeared in Pizza and Property podcast. I think 2 or 3 days ago, they've released the video. A month ago, I was with Phil Tarrant at Smart Property Investments. I've done podcast with Mike Mortlock from MCG Quantity Surveying. I have done other podcasts in the past. I'm doing another one towards the end of this month, and then a few articles on news.com.au and realestate.com.au. So if you search my name on the Google, you should be able to find the link to these articles. Okay, over to you, Deepak, for your intro. I think you are still on mute, Deepak.
Okay, for me, and I moved to this country in 2016 after spending 10 years in telecom, and I did some odd IT job, and I've been part of the InvestorAid since I think inception of this, and I know Rohit from back in my university days, and since then I joined InvestorAid, and I've secured like around 80 to 90 properties all across Australia, and I have a very good experience in targeting market where the actual value of a property is quite undervalued. That's it for me, Rohit. Over to you.
Okay, perfect, Deepak. Thank you for the intro. Okay, so a disclaimer, Deepak.
Okay, so this is kind of important, guys. Before we move further, this is the longer version of the disclaimer, but I would like to read the smaller version of it. This information we provided in this webinar is for the general information purposes only and does not constitute financial, legal, tax, accounting, or property advice. It has not taken into account individual objectives or personal circumstances. Before acting on any of the content, we strongly recommend seeking advice from a qualified and independent professional relevant to your situation. Thanks, sir. I think we can get started. Next slide.
Okay, perfect. Yep.
Yeah.
Okay,
Be-
so
It's sorry to cut you off. Before we proceed further to know our audience better, can we just Maggie, can you start a poll so that we know whom we are talking to?
Okay, so if you can just respond to these questions. So which of these describe you? So are you first-time investors and no property yet, or own a home but never invested, working a professional invested in property, just curious learning, currently using reinvesting strategy? Yep. We have just got 2 seconds remaining, guys. Okay. So 7 people out of 12 have responded. Okay, so 2 people are currently using rent vesting strategy, which is great. So they probably know about it a bit. Two are just curious and learning. That's the best way to start. And then one is a working professional. Oh, sorry, two are working professional, interested in property, and one is first-time investors, no property yet. Great. Perfect. So let's get into it now, right? So rent vesting, again, as I described earlier, rent vesting is you are continuing to live in the lifestyle location or in the location where your needs are met, and that may not be affordable to you, or you choose not to invest there because of other goals and objectives that you may have in life, right? So you continue to rent where you want to live, and then you invest where it is financially beneficial for you in the future, right? So this is what the picture depicts. Like left is the lifestyle location where you're renting, and the right is basically the suburban areas where there is more capital growth and or capital appreciation is expected, right? So whenever, so there is a concept again on back of this. I'll also want to explain that there is a concept called yield compression, right? So say, for example, if you're living in an expensive suburb in expensive capital cities like Sydney or Melbourne, then the yields in those suburbs are quite low, right? So if you end up renting a place, you end up paying a lot less in comparison to the mortgage that you, the gap between your mortgage and the rental repayments are quite big, right? Which basically again is a driver for people to be uh, to be going the rent vesting route. So very, very important for people to understand who are especially living in expensive pockets, that rent vesting could be a very good strategy, because this yield compression basically compresses the yield in as the price increases, right? So in very expensive pockets, the rents are not as expensive, and then you basically take the benefit of using your money and getting that invested into the right markets. And also, when these some of these premium pockets are too highly priced, affordability pushes people to other pockets, right? So there are sometimes better capital growth prospects in the cheaper markets because there are more people who are eligible to take mortgages to be able to buy there. So the demand again in affordable pockets are much higher in comparison to an expensive pocket because less people can afford that.
Yeah. So just to sorry to cut you off. There is one more poll we want to ask our audience just to understand the biggest concern about investing in property. And here's the poll, guys. Can you please answer the question? We got like 20 seconds left.
Yeah, okay. Biggest concern about investing in a property. Okay.
I think fair enough. Yeah.
This is good. Okay.
Yeah, this is good. Yeah.
Yeah.
Thanks.
Okay. So out of 6 respondents, out of 14, uh, four think that they are afraid of making a bad investment decision, and it's a very, very common thing. So people are fearful if they are not aware of what they are doing, right? So once you're familiar and aware on how things work, then the fear starts fading away. So I don't know how to research markets. Yeah, fair enough. And all of the above. Okay, so it is again, all of the above is again basically tying back to the fear and not knowing what they are doing.
Okay.
So
Let's go proceed. All good from here.
okay, perfect. Okay, so the concept of rent vesting, as I've described earlier, right? So rent vesting, basically you're renting where you live and then buying an investment property in growth location. And eventually both of this ties to the wealth building, right? If that is what your goal and objective is, right? So this basically means that it's basically a mindset shift, right? Some people think that owning a home is the place where they is what they want because of the emotional reasons. But again, that also means that you are compensating on your future financial gains for because of the emotional reasons, right? But and I'm not an advocate here that rent vesting is good for you or not good for you. Rent vesting is just a better financial outcome. That's what I'm saying. So it is very similar to if you decide to buy a Ferrari, right? Like I wouldn't say a Ferrari is good or bad because Ferrari may not be the best financial decision, but if you are heavily emotionally bought into Ferrari and you want to buy it for your own personal reasons, then yeah, it may be good for you, right? Financially, it may not be the best, right? So rent vesting is financially a better decision, but whether it is the best decision for you, it is a call that you have to make because it is a balance between your emotion and what you want to go do ahead financially in your life. Okay, so it's just a mindset shift. Okay, so how rent vesting works step by step, right? So you're renting in a preferred lifestyle location or the desired location based on your needs and your work locations, and then you are buying an investment property in an affordable, growth ready area, right? And then you are also, as in terms of rent investing, you're managing your cash flows, you're managing your tenants properly through your property managers and the property, and you are then reviewing your portfolio over time and how it is performing, right? So rent vesting specifically, so when you are buying it in affordable markets, when I'm talking markets here, I'm talking regions or cities, right? So whenever we are talking markets, like whenever we are talking about capital growth, essentially rent vesting is beneficial because you get far better capital growth by investing, by not restricting yourself to the geography where you have to live, right? Because what happens is if at any given point in time, every like in the next 12 months there are going to be markets which are going to be booming. It may not be the market that you are currently residing in because of your personal reasons, right? So whenever you're ready to buy your owner occupier in the place that you're living in, that could be the best time financially to buy there, or that could be even the worst based on market cycle timing. But if you de-restrict yourself or from the location that you are currently required to live, then you are opening up yourself to whole of Australia, right? So then you can always keep tapping into the right markets which are poised for growth in next 12, 24, 36 months, depending upon again your objectives, and you can always ride the wave of growth. So when someone asks me, man, uh, you have done significantly well because of the time, but would I be able to make money in next 12 to 24 months? And the answer is yes. It may not be exactly the same money which somebody has made in the past, but it would still be a lot better than what you would do by investing in the locations that you're currently living in. So understanding the market cycle timing is crucial because when you are talking capital growth, 70 to 80% of the heavy lifting is done by the market cycle timing. So you can buy a dead asset, and I'm just sharing my personal learnings that I've had in the last 4 or 5 years of personal investing and then running bars agency, working with hundreds and hundreds of clients and seeing them succeed. 70 to 80% heavy lifting is done by the market cycle timing. So, which basically means even if you buy a dud asset, the worst asset in a location where the market cycle timing is favorable, it will still do far better than the best asset in the best locations in a market where it is not favorable, right? So the region does the heavy lifting. There is a saying that rising tide lift all ships, right? It's very similar to that. As long as you just get your asset type right, and then you are buying in the best, sorry, in the location where the market cycle timing is favorable, you would do a lot better than the rest of the investors, right? Then once you do that, then you get to the next stages of getting to the right suburbs, the right property, and then doing everything else from there. So rent vesting basically helps you in that. It basically gives you the ability to invest anywhere in Australia where it is the best time to invest today. As long as you know how to find that location and do everything else that a good investment purchase needs to do, then you are in the right direction. Okay, so now why should you consider rent vesting? So this again gives you flexibility because you can then live where you want and invest where the growth is strong. You don't need to be making compromises on your lifestyle that you are moving to places where the capital growth is more, or you are probably then making a sacrifice by investing in a market where which is in a closer proximity to your work location, but it may not be the best market. So I always tell my clients one very clear thing, right? So when they say, man, I want to buy an investment property, but in future, I may make it as an owner occupier. So I always tell them clarity is power. Whenever you are starting, just be very, very clear and upfront on what the objective is, because the direction might change completely. Because if you make a compromise, so if you come up with an intention of buying an owner occupier with plus an investor asset, which basically serves both purposes, in true sense, it basically serves none of them. Because when you are buying an owner occupier purchase, you might be making compromises on the location, because now you are looking more for convenience than the growth indicators, right? And then it may not even, and tomorrow when you plan to move there, it may not be the best location to live based on your lifestyle, even because you have made some compromises because of the capital growth, right? So it neither turns out to be the best owner occupier purchase, neither the best investment purchase. So clarity is very, very powerful here, right? So it also permits you to start building wealth without waiting for your dream home, because especially for people who are living in very expensive cities, they need higher deposits. And when I say higher deposit in terms of dollar value, because if you're targeting a $2 million purchase in Sydney, it's quite common. Most of the pockets, like many of the pockets, are touching $2 million now, right? So even to get to 10% of the deposit along with stamp duty, you're looking at 250, 300K, right? So that itself becomes, and then the LMI is huge. But even if somebody is paying 10% deposit, which is 200K, then 80, 90 grand in NSW as stamp duty, like 280 to 90K. In order to get to that, someone might be taking 3, 2, 4, 5, 7 years, right? During this time, if the market shifts quite a bit, then they are again left far behind, right? Because they then need to keep bridging the gap, and the market is moving faster than they can move their deposits, right? So during this time, while all the markets, like not just this market, but the other markets are moving, they can actually benefit and ride that wave of growth. So rather than waiting on this and then relying on only on their sole income, because with the sole income, the biggest problem is that you have got huge tax consequences. Regardless of how big of an earning you are making, you are paying 45% above 180, 190. Again, no accounting advice here, but it's just a normal tax calculations that you can do on any online tools, right? And if you get to about 250, 300, then there are more tax implications, right? So a better strategy there to come up with your deposit could be investing while you are getting ready for with your deposit. You can use the deposit rather than keeping it in a savings account. You can invest that into the investment assets and let them grow, because with investment asset, if you hold a property under personal names and under trust, like after, again, no accounting advice, I'm just giving my general information that I've got. After 12 months, 50% is anyways tax is exempted. 50%, even if it applies on the remaining 50, it just becomes 25. So lot better tax effective way to be even getting deposit ready, if that is what your objective is, right? If the objective is to have a dream home and just your savings are not enough, then rent vesting again could be a way for you, right? So enjoying lifestyle freedom while your asset grows, right? So you want to live in Bondi Beach where the houses are 8, 10 million and you probably couldn't afford, right? So you can actually live into those locations in probably much cheaper rental in comparison to what your repayments could be, right? You may not take mansions, you might take just an apartment, which by itself is not a good capital growth asset. So you may not want to park your money into that asset because it is not the right capital growth asset, right? So you want, because you don't want to be in a position where you bought an apartment for $1.5 million and 6 years down the track, you are still sitting at 1.6. In this time frame, you want your money to be growing from 1.5 to maybe 2, maybe 2.5, depending upon where you end up investing, right? So you want your money to be growing faster. So in that time frame, you can actually rent and in the lifestyle location that fulfills all other objectives of your life, right? So, and as I said earlier, right, it also gives you a flexibility of entering the market earlier and stay ahead of the rising prices, rather than just waiting for the deposit to get ready, which could take you however long, right? And then also it helps you build portfolio, right? And this is, I think, the biggest benefit, because what with real estate, the biggest thing is like these gains. If you make 200K from a property, it may not sound like a big gain, right? But 200K could mean a stepping stone for your next property, which could give you another 100, 200 gains if you are investing strategically and in the right markets, right? So I have built my whole portfolio in last 5 years and made more than $5 million in equity. Like, have I made it from one property or two property? No, not really, right? All the equity that I made is in multiple assets because my first asset helped me get to the second one, and then second one got me to the third one, and then third one again sequentially, like I'm then using equities from the past purchases, right? So, and while you get to fifth purchase, you might have a portfolio of five properties where all these five properties are probably rising at 5% per year, right? So in terms of when we talk portfolio, right, portfolio is nothing but a collection of properties. So when we are talking portfolio, say for example, let's assume we are only relying on CoreLogic's average last 30 years average, which is around 5.4% CAGR, which is compounded average growth rate, right? So this compounded average growth rate of 5.4% on $1 million portfolio only means that your property portfolio is growing by 54,000 each month, each year, sorry. But if you grow your portfolio to 10 mil, then even on the CAGR of CoreLogic, which is an average, as an average Australia-wide regional capital for last 30 years combined, even at 5.4, you are making over a $500,000 in equity per year, right? So that is the power of leverage. You are using somebody else's money to make your own. So you can use that because see, for making any purchase, right, you need two things. You need a deposit, you need a borrowing capacity. So if you are working with the smart professionals who can work out your borrowing capacity, there are ways again how you can actually work with them creatively to basically best optimize your borrowing capacity, and then your previous purchases are helping you with the deposits. That's how you get financially ahead in life. So I'll move on to the next one because this is a topic that I love, man. I can keep talking on this for hours and hours and hours. Okay, so now we get to the 7-step framework, how we get started in rent investing. So the first thing is, again, as I said earlier, it's clarity. So you need clarity in your goals. So you need to be clear on your purpose. What are you aiming for? Right? So is it long-term wealth? Like, is it buying your principal place of residence? Is it leaving money behind for generational wealth? Or is it just creating a passive income so that you can retire early? So clarity in goals will determine what strategy you should be using, which I'll be discussing in the subsequent slides. Okay, then getting financial ready is the next best step. You need to be financially ready, not in terms of your borrowing capacity, but also your deposits, right? Make sure the first or the next purchase that you're wanting to make, have you got the deposit and the financial ability or the borrowing capacity sorted from the broker or the lender? If they have given you a verbal approval, ask them to give you a pre-approval, because in some cases, pre-approval gets you ahead of the competition, right? So getting ready with the pre-approval is very, very crucial, like could be very beneficial for you down the track. Also, another thing is regarding your repayments. You don't want to be consuming everything that you have got in your savings account. Just have some buffer in place for any unanticipated maintenance that might occur, because you are buying a property. Always understand, when you are buying a property, there could be air cons which might stop working. There are things like, even if you buy something which is newer, there are things which will, because each component in the home have got their own lifespan, right? Even if you buy a 7-year-old property, the carpet has got a lifespan of 5 to 7 years, right? It might need a new carpet. It might need a new air con, right? So be very well prepared. So have 3 to 2 months of repayment as a buffer, which might cover for the repayments or the expenses. Are you guys following? I just want to see a yes, so that and if I'm tracking too fast, you want me to go a bit slow, or is it just the right place for you? Any yeses if you are comfortable? Good. Okay. Thanks, Brett. Okay, perfect. So we will continue. Okay. And then the next step is, once you've made sure that you're financially ready, now you need to be researching to the right markets, right? So look beyond your current location, right? It is very familiar, like it is a very usual trend where people start investing in their backyards. When I say backyard, doesn't mean literally backyard. It just mean in the same suburbs or the suburbs that they have been driving past by and have heard from their barbecue friends that is where they made money 6 months ago or 6 years ago, or however long, right? Like investing in locations where the fundamentals are strong, where there are job growth, where there is job growth, where there are major infrastructure projects, where there is a rising population, where there is a strong rental demand is very crucial. You also need to be looking at vacancy rate because this is going to be a rental property for investment, right? Just monitor vacancy rate. And when I say monitor, it means look at the point in time information and also look at how is it trending, because trends are very, very important, right? So say, for example, if the vacancy rate is 3 today, which is considered healthy, but if it is trending up, it means like in 6 months, 12 months, it might be higher than that, right? Which could be a red flag for you, right? Again, not saying it is a red flag, but it is one of the red flags that you might have to consider before making that decision. Then you also need to be looking at rental trends. Okay, so the next step is choosing the right property. So you have found the right markets, you've chosen the market, you've chosen the suburbs. Now you need to get to the right property. You need to look at the investment grade assets, not just CPs. So understand, when your intention is to get an outcome from a property, you are not wanting to stack GPs because of whatever reasons, right? I've seen people coming to me that, man, I've got an 800K budget. Can you buy me two properties? I said, and these are my past clients, and I've told them very, very clearly, I can, but I won't. It is good for me. I will be charging them fee twice, right? But I know when up you won't be getting the right assets, which is the best financial decision for them. I don't even do that. The reason is because I know they won't be able to succeed there, and I would be tagging a failure to my brand, which I do not want, right? So always remember, budget is a constraint, but you don't want to be focusing on just quantity than quality, right? So look for strong land to asset ratios, family friendly neighborhoods where there is an owner occupier appeal, and there is because if the owner occupier appeal is higher, the renters also want to move there. And then choose the best asset type. And everyone knows now there is nothing better than a freestanding home. So if you buy even in the right markets, in the markets where the market cycle timing is favorable, but your asset type is an apartment, then don't expect it to do as well as the other better asset types like townhouses or houses, just because you have compromised on the asset type. So in order for you to have capital growth, you need to be doing three things correctly. You need to be buying the best asset type, which is nothing better than a freestanding home in the right locations where the market cycle timing is favorable. If you do these three things correctly, you have the maximum potential for capital growth, which can essentially lead to whatever outcome you're wanting to achieve, right? Okay. So then structure your finances and purchases smart. I'm just seeing how we are tracking with time. Okay, 8:05. Great. So structure your finances and purchases smart. As I said earlier, like if your intention is to build portfolio and not buy just one and two properties, then start working with professionals who have actually gone that far. Don't work with brokers who just do pay-YG lending and who just can help you for one and two purchases and then they max out based on their capabilities, right? Or that's probably their plain vanilla deals and they don't want to bother with complex deals, right? And also get your A team prepared, which would be conveyancer or solicitors and building and pest inspectors that you may have to use once you happen to make the purchase in the region, right? And then when you are basically putting offers on any property, right? Never put offer on emotions or your sentiments, right? Or I have seen people so many times in my life where the sole strategy that they have got is they just put 10,000 lower than the asking price without understanding where the market should be sitting today, right? So you need to be looking at the recent sold comparables. Also, don't rely heavily on RP data's automated valuation models and price finders valuation models. The reason is because they are like, if you understand machine learning algorithms and how how they basically train their data models, they are relying on a data which is 3 months old because this data is being fed from the titles office. So you could be looking at, like if you're looking at AVMs, that AVM might be picking up the comparable data which was probably got under contract 5 months ago and settled 3 months ago. So that could be too much outdated, especially in fast moving markets. If a market is moving by $10,000 and that AVM is picking up something which got under contract 5 months ago and settled 3 months ago, then you are probably looking at 40, 50,000 off, right? So look at the sold section of the sales portals for you to understand what is happening today on the ground rather than what happened a couple of months ago, especially in fast moving markets. So never base, also, like if you are doing an, usually this webinar is not for owner occupier, but if you're doing even an owner occupier purchase, still base your offers on comparables, not emotions. Okay, so the setup property management. Again, sorry guys. So setup property management, again, setup basically means that you work with professional property management there and understand what their processes are, what their tenant screening process is, what their routine inspection looks like, and understand their overall work process, right? So whenever you're working, like engaging any professional, understand how they work, right? You don't want to be again picking property management just based on the fee. This is because cheap can be very expensive here. So just be very cautious whom you are picking up. I keep hearing, because as part of our service, we always recommend good property managers whom we have tried and tested and also interviewed when we started working with them. But I've seen people who just went with cheaper property managements just because of 1% fee, lower fee, and then they regretted 6 months later that they had terrible experiences, right? So fee shouldn't be the only criteria when you're choosing property management. Look at what they do end to end, look at their Google reviews and see if you can speak to any of their existing clients if they permit you. And then always protect yourself with landlord insurance. It just costs you around 360, 370 bucks with Teritiare for the landlord cover to protect you against any malicious damage by the tenant or any rent arrears. Always make sure that you have got them. Okay, this is the last one that I want to talk about. It's manage and review regularly. Now you have bought the property, but your goal was not to just buy a property, but probably achieve certain bigger outcome. Now you want to see how your rents are tracking. Are they on the market rate? If the rents are rising, are you keeping up to date, right? So if you are monitoring, like if you think the expenses are too high, you probably want to see what the expenses have been. And is it because your property management is just raising everything with you for in order to have property into the best shape? They should get it in the best shape, but sometimes I've seen property managers where they are just raising every single minute issue with you when it can just wait, because it is much cheaper for you to get a single tradie for 4 jobs than getting him at 4 times, right? So just monitor your expenses and see how it is tracking. And if you see too many single trade coming too many times quite often, then you might just want to wait to get things collected if it is not urgent again. And then review your rents and then keep raising if the rent are rising in the area. And then check your property value every 6 to 12 months if your objective is to buy more. Because if you are buying this in the right markets, then you can expect these properties to be doing well and have some equity for you to be able to use for the next one as a deposit. And then refinance strategically when the time is right. Refinance them when you think like you have spent a couple of years with the lender, there could be better rates that can be offered to you because your property has risen significant in value, the LVR has dropped. LVR is actually a loan to value ratio. So if your property has risen value and your loan remains constant, the loan to value ratio reduces, right? So when your loan to value ratio reduces, there are some lenders who might offer you better deals. So just refinance when you think the time is right. Right. So some of the common mistakes that you should be actually avoiding, and people usually make them. Like I see like lot people sitting on the left, then people on the right. Right. So waiting too long or buying emotionally, right? Waiting too long, I think, is a bigger problem than buying emotionally, according to me, because the biggest thing, I think, the biggest risk is taking not taking any risk, right? Because people are just waiting on the sidelines too long, been looking since 2021, still on the sidelines and not decisive. They were financially ready then, and like when they thought the property market is expensive in some parts of the country at 450, and they want it to be coming down and cheap, and then when it started moving higher, when they have left a property at 450 and then if it has moved to 470, they really can't buy because they were not even ready at 450. And then once they make themselves ready at 470 and the market shift to 500, they again can't buy, right? So waiting too long basically just makes you sit on the sidelines and then you keep missing out, right? So always understand when you are investing for an outcome, take the emotions out, be strategic, and make your decisions based on data and the market cycle timings, right? And then again, skipping proper research is another one. Many people, like most people, don't are not able to buy. Just give me a second, guys. Just put my phone on airplane mode. Okay, so skipping proper research. So this is another issue where people are just buying based on what their friends have bought or what they are familiar with or what they might have seen as an online ad, that there is someone taking 5% deposit on a 350K land in the middle of nowhere, but they have to pay that 5% now and don't pay anything for next 3 years. So they are committing to a purchase for next 3 years in middle of nowhere. So be very cautious when you are doing that, because what you in real estate, the biggest problem is what you are doing today, whether you have done it correctly or whether you have done it wrongly, you wouldn't know until next few years. So you need to do a proper research before you start taking action, right? So invest only in regions where there are fundamentals, strong fundamentals, right? Where there are enough jobs, where there is enough population, there is an increase in population, there is enough infrastructure or new infrastructure coming in, and there is enough demand, obviously, right? And then another mistake is poor finance or cash flow planning. Okay, so this is again very crucial. So poor finance basically means that you have probably not taken your finances nicely, because you say, for example, someone who's wanting to buy property but have been spending too much, not focusing on their cash flow, and they are not getting ready with the cash deposit that they needed in order to progress, because your first property or initial few properties are going to be the stepping stone of the portfolio that you're wanting to build. If you don't get them right, it will set you back for next 10-15 years. So getting your finances right for the first one is very crucial, because you don't have any portfolio to or any property to fall back on for your equity. So you need to be using your savings. So your saving strategy has to be better, at least for the first or the first two properties, right? So your cash flow planning is super crucial. And then also you need to be working with a broker and then have some buffer in place, as I said earlier, right? So, and overlooking property management, which I've touched upon, like people should be working with professionals who are really good at what they do, rather than just picking up professionals based on the fee and comparing, because that is the biggest difference between a product and a service. For a product, there is a specification, but for a service, you would find a $50 hotel and you would find a hotel for $5,000 a night, right? There are difference between them. So just don't pick any service based on the price, right? So overlooking property management can again be a very big mistake. And then again, listening to wrong advice, listening to people who have not done it themselves. So if I go on a barbecue and meet someone who has been in the country 20-25 years, they've never invested in property because they thought it is a bubble, or might have invested in one, have paid it off, and then I'm wanting to build a different portfolio. My goals are very different from them, but then I'm taking advice from them. That by itself is a very big red flag for me. Never listen to someone who has not done something that you want to do, because if they were that much informed or educated and were really wanted to do that, then they would have done it themselves. And then if you were taking advice, then that would have been a sensible approach. So but yeah, just don't look at, because you know them for so long, just don't follow or take their advice. Again, I would not be making this client success story, because we have got lots and lots of story which you can check on our websites. But this is, we are just picking up two examples of IT professionals who have never ever bought any property in Australia. They went the route of rent vesting. This guy, he has been working in Macquarie Bank as an IT engineer, and they have been renting in their apartment at Macquarie Park, and then they moved in Sydney, and then they moved into a rented house in the Ponds in Sydney again, and we have bought property number one for them. And they have been sitting on the sidelines, I think, from before buying this property, been on the sidelines, like I think for the last two years before that. So then they decided they want to buy, because they have missed so much of capital growth opportunities in COVID 2021 and 2022. They got started. They initially, when they started, they thought they were late, right? So we bought this property, first one for them, at 445. Its current value today is sitting, how much time are we talking? Less than 2 years, right? So its current value is sitting at 627. The second property that we bought for them, this time they were thinking they were a bit too late now, right? 580 looked like the very high price, but now the current value is sitting at 830. So again, high price doesn't mean that it doesn't grow further, right? As long as the other fundamentals are strong and the affordability is still there, you need to be looking at the affordability index of the people in the suburb. So if the affordability index works well or is it favorable, then this will keep rising, right? But again, based on market cycle timing and few other parameters. Then the third property that we have bought for this client is about to settle, I think, next week. So the combined equity that this guy has created is $432,000, 40.9% capital growth in 22 months in the first one. The second one is 43% in 17 months. Another client success story. This is second client. Again, Amit, this guy works at CBA as an engineering manager. Wife, I think, works in a telecom firm as a software engineer. They're still living in a rented apartment in Epping in Sydney. We bought first property for him. We bought second property for him. And this guy is a bit cautious, like, and he's just taking it too slow. So he is, despite making good capital growth, he's still taking steps in a lot cautious manner. But he has still made $450,000, where 57.6% capital growth in 27 months, which is a fantastic outcome. And when we say 57% capital growth, this is more than, I don't know how many hundreds of percent of cash on cash return. This capital growth is on the total money, and he has probably taken 90% of mortgage working at CBA. So his cash on cash return would be a few 100% here. He would have invested, I think, probably 42,500 plus stamp duty, like 60, 70 grand total. And he has made how much? If you basically reduce, he has made a couple of 100,000, I think over $200,000 here by just investing 60, 70K.
Close to 3x.
That is correct. Yes. Okay. Perfect. So yeah, these are the two. I won't again get into the numbers. You would have seen it, but again, there are so many results. So see, again, real results. We have helped 200 plus clients. This is now about to touch 300 now. So, but 200 plus clients who we are just buying in. And see, again, as our brand suggests, we never work with owner occupiers. We only work with investors. So we help people build portfolio. In the last, I think, 12 months, I have helped 10 plus clients for whom I bought 4 plus properties, right? So, but again, those are not rent investors. Many of them were having their own principal place of residence, but have never bought any investment property after that. And we help them scale their portfolio. Okay, so with our proven strategy, with our proven approach, again, we do that.
Yeah, and Rohit, before we proceed further, and we just like to run a quick poll about how the audience feel about rent vesting after these success story and what we have done for our client. Maggie, can you please throw in the poll,
Just a
please?
second, Deepak. So we'll do that once I finish this. Maggie, we'll go back to that.
Yeah, sure.
Let me finish the slide and we'll come to the poll, right?
Okay, no problem.
See, the 200 plus clients that have achieved this impressive results by buying more than one like these 200 clients, we bought one properties as rent investors, but then there are multiple clients for whom I bought couple of properties in the last 2 years, 2.5, 3 years, whatever we have been operating in, right? So, and the results have been between 50, 70%. So we, like on our website, you can actually find these results very clearly showing on what they have achieved. And if you are curious about any of those results, we can always deep dive and discuss. So Maggie, you can go on and let's do the poll and understand from our people here. Yep. Reaction to success stories. Okay. Let's see what they feel about this. Leave it for 30 seconds. Yep. Okay. I think we are getting close. Okay. Fired up, ready to start, which is great. Interested but cautious. Great. Still a bit skeptical. No one. Inspired but need more info. Great. So you can always reach out to us if you need any info. Our details in the last slide. Okay. So let's move on to the next slide. Okay, so how a buyer's agent can help? See, we are this profession. I'm not saying it's just us. It would be any buyer's agent who is actually doing a good work, right? Again, you need to figure out who does good work, but leave that to you. But whoever does good work is essentially expected, especially with investors, are expected to do these things, right? So they should be helping you with a deep, in-depth research of the areas that you're investing in, And when I say areas, regions plus suburbs, and then their experience and skills, their personal experience, their team's experience, you should be leveraging on that, right? And then they are again an expert negotiator, because usually a buyer's agent who's negotiating on, like, say for example, if a buyer's agency or a buyer agent is doing 4 or 5 deals a month, he might be negotiating on 50 a month, right? Or maybe 25, 30 a month, right? If they, like, if you do extrapolate that for a year, they might be negotiating on 300 deals, right? So they just get better at negotiations, they learn from their mistakes, they keep improvising, and they, based on their experience, they really get better at negotiation. It's just a matter of practice over perfection, right? So, and the main critical part is that they handhold you from searches till settlement. So they'll, when I say search, it's not just the property search, it's the area search, region search, and then taking you until settlement, right? So what basically means is identifying the right markets, shortlisting the properties that fit your goals, secure them at the right price, and then again removing any guesswork. Okay, so this is where 99% investors go wrong and don't get past 2, 3 properties, right? People usually think because they have got a budget and they can buy, because they can afford to buy, they end up buying whatever either someone they know has bought, whether it has performed or not, but because of the familiarity they buy, or they're driving past something, they see a for sale sign, and they, just because they are familiar. I know a lot of people, even personal friends, who have bought 2 or 3 properties all in the same suburb that they are living in. Very, very common approach, right? But this is the actual reason why they never get past 2, 3 properties, because for someone living in expensive cities, earning decent wages, may be able to get to 2, 3 properties, but they get stuck, they then get stuck, right? So our approach is very different, right? So we always, whenever someone comes to us that I need your help to buy a property, I always want to understand the why behind it, right? Even in our discovery calls that we do with anyone who is interested, the last question is, I want to understand your goal first. So you have talked, this is your budget, you're wanting to do this, but what is the why behind this? And I'm not discussing how here, I'm discussing why. What is your goal? What essentially are you wanting to achieve? Understand, property is just a vehicle to achieve that, right? It could be through shares, it could be through ETF, it could be through anything, it could be through crypto. Property is just considered a much safer asset here in Australia, and for that reason you are just picking property, but essentially you are chasing an outcome or a goal, right? So I want to understand your goal or objective first, before I, because what I have see quite often, like lot more than, like I see it a lot often, and what I see is that what people are planning to do versus what they really want, there is a very big misalignment, right? So people are wanting to retire on passive income, but they think a property is going to provide them, and they end up buying a property in their backyard. And then in 10 years time, they realize, man, this property needs another 15 years to pay off. And then they would be getting maybe maybe $1,000 a week as a rental. So 25 years, single property hasn't helped them get to the next one. And this is what usually happens, right? So understanding a goal objective is super crucial for anyone who is wanting to invest in property. Whether you are rent vesting, means you have never bought your principal place of residence, or you have bought a principal place of residence but want to invest to grow. Understand your goals, and based on your goals, you want to formulate a strategy to reach that goal. And then all your asset acquisition should be aligning to that strategy to reach so that it is taking you closer to your goal, right? So once you have finalized your strategy, you want to find the regions where that strategy work best. So if your strategy is different than my strategy, then the regions that you should end up choosing should be very different than what I should be choosing, right? And that is the reason why we are buying currently in 5, 6 markets for our clients, right? Because the goals are different, the strategy is different, then the region ends up being different, right? And once you have narrowed down to the region, as I said, 70, 80% heavy lifting would be done by now. Now you need to be getting the best suburbs, because you don't want to be getting into the suburbs which are probably not that affluent, right? You want to get to the best suburbs. So based on supply and demand data metrics, we do a lot of data analysis in the back using multiple data tools. But using these data metrics, oh, sorry, I forgot to mention, in my past role at Combank, I have been a data engineering manager, managing a team of data engineers, senior data engineers. Okay, so these data, using these data analysis, we will be selecting the suburbs where the supply and demand fundamentals are very strong. And then once we have done the suburb selection, then we get to the property sourcing. And here we also use leverage the benefits of leverage the local knowledge of property manager on the ground to get to the right pockets of the suburb, which we really cannot do using tools. We need to use local knowledge, like from people who have been on the ground 20 years and know the days and the streets in and out, right? So very, very crucial. If you get these things right, then you are on the right track. But just don't think about property, because property is there to give you an outcome. So start from an outcome. Okay, so now I think we are towards the end of our webinar. I think we are tracking well on time. This is actually,
Right, just sorry to go. I think we missed a slide. There's one more. Is this?
yeah, that should,
Okay, yeah, that's fine. Yeah, this is after this Q&A. Yeah,
no problems.
yeah.
This is a time when you guys, either you can just type the questions that you may have in chat, or just unmute yourself or raise your hand. I think there should be an option for you to raise your hand. Just raise your hand and then we can start unmuting people one by one, or you can unmute yourself. And then I'm happy to answer any questions that you may have. Just educational, like whatever you want to know from me. Rosie, so our fee, we will be discussing that one to one. So our fee, as I said, like, because the reason why we just don't say fee here on is because, as I said earlier, we are not a product, right? We are a service model, and I will need 45 minutes to be explaining how we work end to end, right? So service fee would be very different for different buyers agents based on their processes, their level of expertise, what they bring to the table. So we disclose that in our strategy call when we are educating you on our process, our whole value proposition of service, and also the cost. So the value and the cost gets discussed together so that cost makes much more sense to you, if that makes sense. Hope that helps you. Yeah. Okay, perfect. Any more questions that we may have? Yep. And if anyone wants to be on mic, yeah, just feel free. Should. Is trust helpful in building property portfolio? Yes, definitely is. But again, there are so many considerations when you're using trust, right? The first consideration, okay. So we'll go one by one. So is trust helpful in building property portfolio? Yes, it is. But a few considerations there. You need to be mindful of uh, the land tax thresholds, because land tax threshold under trust and under personal names could vary between states. You also need to be looking at the gearing aspect, because trust do not allow you to negatively gear that against your active income. Your losses, if it is negatively geared, it gets trapped under a trust. And there are a few more things that you might have to consider. But again, trust in borrowing more, yes, it is helpful. And someone who has to scale their portfolio, this is a tool that they should be looking at some point in time. But again, it has to be used very strategically. If you use trust without knowing all the aspects, trust could be a problem for you. Hope that answers your question, sure. Yeah.
Right, there's one more from Brett.
Yeah, Brett. Have you purchased property for clients where you haven't experienced the growth? Man, I would love to, because I've been asked this multiple times and I need to dig deeper. So there are a few ones where they have just grown 10% in the last 7, 8 months. But we actually did that on purpose. So for a client of mine, a doctor client, I bought 4 properties for him. Our goal was very clear. We want to build a portfolio. And when you are building a portfolio, you have to be diversifying not just across locations. You have to be diversifying across strategies as well. Not all assets you want with short-term capital growth, right? Some of them should be mid to long term, but you want longer sustained growth, right? So for this client, we have intentionally bought 2 properties with higher capital growth, which it has achieved. The other 2 properties we have planted in a market which were, I think, bought in last 6, 7, 8 months ago, right? And these properties have just gone 8, 10%, but they have started moving now. I'm expecting these properties to be doing a lot better in 3 years time horizon. I have never seen even a single scenario where we invested in a property with an outcome in mind and it has disappointed us. And when I see, and that is the reason what we always tell our clients, like when we are onboarding people, right? So they say, man, how much percentage growth are you projecting? I tell them, man, my tool gives me projection, but I never give projection to our clients. The reason is because the biggest economists in the country go wrong all the time, right? I don't want to be putting a number of 17.8% and then you get 13.3% and then you basically get behind me saying that, man, you have not achieved, because there are so many external factors. I cannot control COVID too. I cannot control anything else that is happening in the external world, right? So what I tell them, based on all the fundamentals, even in my personal portfolio, right, I have not even got single property which has underperformed. But again, have all properties gained capital in 6 months time? No. The reason is because not every purchase was made with that intention in mind. Does that help answer your question, Brett? Okay, I'll wait for your response. If not, like, feel free to ask another question if something is left unanswered, but I think I probably covered. Okay, yeah.
There is one more, right? I think from
Happy to answer like any follow-up questions that you may have.
yeah.
Which states are you investing in? Do you buy a house? Okay, so sorry, I've not covered this. We are buying in, I think, 4 or 5 states at the moment and exploring another newer market. We only buy freestanding homes. Investor Aid has never ever bought anything other than existing freestanding home. We never buy off the plan. We never buy brand new house and land packages. We never buy apartment. We never buy townhouse. The reason is because freestanding existing house is where the real money is made. The reason why we have not been able to have failure stories tagged is because we don't just take client because they are willing to sign up a fee. So we have got a selection criteria where we first make sure that we align what they are wanting to do versus what they are planning to do or are ready to either learn and adopt and get into the right track, or if they think they're wanting to do certain things which doesn't align with their objective, then we just let them go and don't take them on board. Okay, so this question is, so sometimes you may look for no short-term capital growth and search for cash flow positive assets. We don't buy cash flow positive assets at all, because at current rate of interest, most of the cash flow positive assets are in markets where we would never be investing. See, essentially, as I've done previous webinars. I think on my YouTube channel with InvestorAid, you can find recording of those webinars. We'll be putting a recording of this there as well. So if you go through previous webinars, I've actually discussed exactly this topic and multiple of them. So capital growth is what essentially everyone is chasing. They may not be chasing in exactly the same time horizon. Like, say for example, if I have to rephrase it in a layman's term, say for example, you want to have a big money made. Like, say for example, capital growth is kind of a lump sum money that you're winning out of lottery, right? And you have bought 4 lottery tickets. You don't want to get all 4 lottery tickets to be paid to you in next 3 months and then don't have anything in the next year, right? You probably want to spread it out evenly. So in these cases, when you are chasing, we are always chasing capital growth. We are always chasing capital growth. So, but yeah, not always short term. It could be mid to long term. So, but again, this needs to be again relating back to your goal and strategy, because someone who's just starting out and wanting to build their portfolio rapidly, for them short term capital growth is super crucial. They need to be mindful of their cash flow, right? I they really cannot have properties which are heavily negatively geared, but cash flow positive today will just lead you to very, very different markets. And also understand, cash flow, whenever we are talking, is a point in time information. So cash flow point in time information, because whatever you see in terms of cash flow. So say for example, you end up buying something today and it is $7,000 negative today, right? And you have taken a 700K mortgage on that, right? 1% rate of interest drop basically means you get to neutrally geared. That is how quickly cash flow can change, right? So currently the time that we are setting in, whatever you would see today in terms of your cash flow is going to be the worst case outcome. The reason is because from here, the interest rate is expected to drop further, and the rents, if you are buying in the right markets and the rent rises, the income is going to be increasing, right? So your cash, even if it is negatively geared, it will keep dropping. So there is a concept which says, if you hold a property long enough, it eventually turns into cash flow positive, right? But again, it all depends upon what debt levels we are talking, how much negative we are talking. If I had a $2 million budget, could you easily answer if I would be able to two 1 million properties or one $2 million property? If I would be better off with, I would see again, I think we are again talking properties, again, exactly the same thing that we are talking here in your question, Brett. So we are again talking property here without understanding the goals, right? Without understanding the goal and formulating a strategy. Even if I try to answer this question, it may not be the right one for you. If it was me, if it was me and who was starting out, again, my goal and strategy could be very different from you, but I would have probably in today's time, I would have done 3 into 700K purchases. But again, my goal strategy could be very, very different from what you're wanting to do. So don't take that as a response to this, right? Again, we are talking out of the 5 steps, property. We are trying to find solution, what and where, right? And I first always say why. Understand why, and that's why we get to goals, get to then the strategy, and then it should flow from there. And if that means you have to buy $1 million asset, then go for it, as long as your budget can permit. Hope that helps, yeah? Okay, perfect, Brett. Okay, so what are some of the highest yields and under market amounts? Under market amounts? Some of the highest yields, like, are you asking some of the high yields that I have bought for my clients, or are you asking them highest yields available in Australia?
Tim, if you are there, can you please expand on the question?
Yeah, and feel free to unmute, like if you think that is easier.
Yeah.
Examples of my clients of, okay, so you are asking my, okay, so we, as I said, like we are always chasing capital growth, so our yields, okay, so if you want an example, I'll tell you an example of my property. I've got multiple properties giving me 10% yields. But have I bought them at 10% yields? No, clearly no, right? These properties kept rising in values, and because they were in the market where the rental crisis was there, the rent also kept rising. You would really be surprised on how things start changing in 3 years time frame in terms of your yield percentages. So at the time of acquisitions, the yield could be 6.5%, but then they have started touching 10% for a few, I think one or two of them, right? So, but again, yield is not, again, I wouldn't say yield is not uh, the real goal for. It could be a goal for someone who is in 60s, 70s, has got a lot of cash and just want cash flow from property and no capital growth. Completely fine for them. Again, their goal is different, right? But usually all our clients who are wanting to build portfolios, their intention is to be able to scale. And yield doesn't help you scale. Yield helps you in expanding your borrowing capacity slightly, but then you would always need a deposit to be able to buy next one. And if you are relying on your after tax savings, that is the slowest way to come up with a deposit. You always want your property to be doing the heavy lifting for the deposit, if that makes sense. Yeah. Does that answer your question, Tim, or was it anything else or specific you were asking? Yep, we'll wait for them to respond. Anything else from anyone, guys? More than happy to answer anything. Just ask me. Hey guys, anything? I need cash flow in my portfolio at the moment. Okay, yeah, then yeah. If that is your goal, then yeah, you can. Cash flow can be, yeah, but just be very careful. Just be very careful of one point, and I think you probably know this better. Uh, just basically don't focus on yield only, right? Like also look at the okay, now I understand you have equity, but what I'm saying is just to chase yield, you don't want to be investing. The best yields today can be taken from the mining towns, right? But you don't want to be investing there because not only the yield, tomorrow your 700K property can fall to 200. Today, the yield could be 1400 per week. Tomorrow, you may not find a tenant at 150, right? There. So when you are chasing yields, also look at the ground. Like definitely, yield should be a criteria, but make sure the other fundamentals of investments are great. You are just not chasing yields and ending up getting into very wrong markets. I'm saying metro areas. Okay. Yep. So I think if you can unmute Tim, I would understand you better because so that I know the context better. For yields, if you have got the equity or the deposit, mere. Okay, man, I think we are too late for Perth. We have stopped investing after buying 50 plus properties there. We have stopped buying, I think 14, 15 months ago. Okay. So what is the minimum yield you would consider when buying a house? uh, Again, this is very specific to a client. It also depends upon what my client financial position is, what kind of asset in his where is he with respect to his journey. So if a doctor client buying his first property has got half a million dollar as a combined income and buying first investment, I'm not too concerned about yield. I should be happy with 3.5, right? But if then there is an someone on family income of 200K bought four properties, then I'm a bit more concerned about yield, right? So usually this is again very subjective. So if I have to answer any of these questions, it has to actually again relate back to a client profile. And that is why once we get a client engaged and onboarded, we do a buyer's brief, understanding everything in detail. Okay, perfect, Tim. Now you have clarified very clearly. So you already have a few properties. So serviceability is the issue to continue. Perfect. So you are not looking at residential. Probably look at commercial as long as you can come up with higher deposit. You can also look at lease docs. We don't do commercial at all. Yeah, we are into capital gains. But if you're capital gains only, but if your requirement is cash flow, commercial could be the way for you. And it has got lease docs, so you don't need a serviceability. The lease of the property will help you take the mortgage. If have I answered everyone or have I missed any?
Let me see. No, I think we have answered everyone. I believe, yeah. There's one. Do you think the Australian house prices have hit the ceiling? Do you advise overvalue property to sell from the portfolio?
Do you?
There is the one coming from. Yeah, that's correct. We need at least I think some
Yes. You need a
30%,
deposit or
30%
peace of
deposit.
mind.
Yeah.
Yeah, you need again, you need higher deposit
Yeah.
or you need to be able to tap into your equity for which you need serviceability. So I think you're better off speaking to an expert broker. As I said earlier in the slides, they should be able to help you out. Yep. Okay. So do you think the Australian house prices have hit the ceiling? Do you advise on overvalued properties to sell? To answer the first question, I personally think we might get into a COVID 2 boom. Not just because I've got vested interest. I personally want property prices to stop because I don't want my next generation to be completely priced out of the market. But the kind of environment we are in, and I'm seriously scared about the first home buyer scheme of 5% deposit, because what it is going to do is it is going to make so many people eligible for and they've kept no income limits. They have kept the purchase limits as so high. So all the affordable markets under the limit are just going to go bonkers, because now understand, as someone who is 22-year-old, doesn't have financial sense, may have not saved any money, but their parents can give them 50 grand, make them eligible uh, to be using as a deposit for a $1 million home, right? In a markets where the ceiling is 1 million, right? So people, or maybe someone who has been 20 years, has never saved money because was spending much and has got a little bit of deposit, but and so you are making a lot of people eligible, right?
Yeah.
There's a lot of demand that is going to be coming back to the market. So I think, and also another aspect is you don't want to be competing against these owner occupiers, because owner occupiers are emotional buyers. They're wanting to get their first home. So if you start competing against them, expect I usually lose my battle to them. For all my clients, I let them take the property, But this basically creates a massive surge in prices. It's all demand and supply, no, nothing else. So I think I used to think it should be the ceiling, but I think next couple of years are going to shock everyone. Whoever is sitting on the sideline is fearful, will just feel like will get left behind.
Yeah, correct.
No. Yeah. Okay. So house
There's a
price.
there's one more thing, Rohit. I think it's more of a comment rather than a question. House prices will rise at least
I'm
50K
reading
on
the
average over next 12 months, probably more.
Yeah, I'm reading the Deepak here. Give me a second, please. Okay, so do you advise on overvalued properties to sell from portfolio? So usually I've never advised any of my clients because they have never got an overvalued property in their portfolio, because they when they came to me, like they've either never invested or invested in wrong assets, and then that's why they have come to take my help, right? So I have advised multiple of my clients to get rid of the dead assets that they've got an apartment holding for 8 years. Like I've probably got, I don't know how many clients in double digits who have got dead apartment, like apartments bought in 2016, and at the moment they can't even recoup what they have paid. So I have advised them to liquidate those assets because that is just a dead weight to their portfolio, eating up their borrowing capacity. And there is a massive opportunity cost, because if that would have been planted in the right markets, it could have been gone more than doubled or maybe tripled by this time. Yep. Okay. So the next question is, house prices will rise at least 50K on average over next. Okay. So this is a comment. Okay. From time. Yeah. See, I wouldn't comment on the numbers, but they are just going to go. So whoever, like, just wait for 1st October, because some of the markets which are very cold, we are working on ground every day. They are starting to become warm, and sellers, like I'm working with on 2 deals at the moment with sellers where they're just waiting until first. Like
Yeah,
they have signed up the agreements, they are on the market, but they're just not selling, getting the desirable price, but they are
yeah,
not decisive because they expect the market to be turning quite rapidly in the next month. But that's just our analysis. We could be wrong. Time will tell. Does it help? Shall That is correct. Yeah. Then
yeah, that is
exactly.
correct. Yeah,
I exactly think. See, under the ceilings, right? Under the caps that they have kept.
yeah.
Yep. Any other questions that you guys may have? Yeah. Yeah. Pretty much. And an emotional first home buyer, I
And
don't want to be man competing against them.
yeah, and Rohit, we were discussing earlier as well. People after 1st of October who were want to buy a property after 2 years because they are not deposit ready. After 1st of October, they will be ready like this. So they
I
will get
can't
into the
even
market.
I can't even anticipate how many people will become. I think like in some markets where only 5 people buyers are ready today, there could be man 15, 20. I don't know. Like we will see how the market pans out. Oh man, Brett, I think you might have to Google. I don't want to do that because I see this first home buyer grant. I'm not talking about the grant here. Grant is just a government lollipop to sell the brand new stuff. The grants are not eligible applicable for existing properties, and we
Yeah,
all
I was reading this website, right? That's from the Australia housingaustralia.gov.au. I can paste that link and you can read about the grant and the what scheme they're gonna apply for what
Yeah,
uh
but more
that's
than the grant, I personally think the you should. I'm talking about the first home owner deposit scheme, which is 5%. It's not a grant. It just means okay. So this one is basically first home owner 5% deposit,
yeah,
which basically means that the first home buyers will only need to pay 5% deposit on all the. There is no LMI. The government is guaranteeing those loans to the banks.
yeah.
Think it is starting with Combank, and then there are other lenders. So because I've received a few phone calls from Combank lenders saying that they are seeing massive inquiries.
Yeah, if you go to the link which I just pasted in the chat, it will tell you who is eligible, what they're eligible, what type of asset they can buy, and all that kind of criteria, all the nitty-gritty stuff. It will give you the whole lot of information on this one.
Yep. So yeah, it is only for owner occupier. That is correct.
Correct. That is correct.
So first time buyers can compete for older homes as well as that is my understanding. Again, don't quote me on these policies. Again, I read as much as you guys, but just because we are so much active and want to understand the impact, so we just read it slightly more.
Yeah.
But this is applicable for existing properties as well, and this is not first home. Anything up to 1 mil for Brisbane, for Melbourne it is 950, for Sydney it's 1.5, and different cities have got different thresholds.
Yeah.
Yep. Any other questions, guys?
There's one more. I'm not sure what's the question, right? It's from Tim. Anything up to 1 mil?
No, it's not. It's just a comment. So
Okay.
talking about the cap.
Hmm.
Yep. Okay. Any questions, guys? If there is nothing, then we can just move on to the next slide, where we'll probably spend a few minutes, and then I think we okay. Will be affected by first time. Yes. Yes, Tim. You're right. Okay. So see. So if you're wanting to build a portfolio, and if you're looking for help, again, only for people who are looking for help, right? Like if you think you can do it yourself with somebody's help, we are completely fine, because the purpose here was just education, right? But if we get any business out of it, no business owner dislikes business, right? So we would not be rejecting a business, but this is just an obligation free chat. Like you can book an obligation free chat. We can go through a discovery call and then understand what you're wanting to do and whether we are the right fit, right? And so each month, I'll just be very transparent. So each month we only onboard 8 clients, 4 clients per fortnight, because I've got a team of 4 buyers agents. I personally, with another buyers agent, work with each client, right? So I've got my limited capacity, and each buyer agent is only allocated 1 client to ensure the quality of the service, right? So that they maintain the best quality of service and are paying enough time and attention to the client. So each fortnight they just onboard one. So for the current month, we have got just 2 slots remaining, and 8 are filled out. And when I say month, like this fortnight is anyways booked. I'm talking about the next fortnight, starting from 16th. And then we are also booked out for some slots for the next month. But yeah, if you are ready, and if you need help or want to probably discuss further on how we can help, yeah, feel free to book this consultation. So my team will be putting a link in the chat now.
Yeah.
Uh, Matt has put a link in the chat. So just go through that and feel free to book that consultation. I'll just leave it there for a minute or two for people to be like, if anybody is interested, or we can go back to the Q&A if anybody has got any other questions that is left unanswered.
Yeah, there's one more poll, right? We want to run at this time just to see that what next step most likely all our audience want to take after this webinar, just to give us an idea where we are on the where they are on their journey. Maggie, can you throw in the question, please?
Perfect.
Yeah.
So one more thing. Once this poll is done, this is done. Okay, so you want to speak to 3 people, speak to a mortgage broker, which is great. Go and reach out to them as soon as you can, because with this inquiry, everyone takes a mortgage. These people are also going to be a lot more busier. I was speaking to a broker this morning, and he said, "Man, I am like," he was just talking about his business model. He was saying, "Man, I'm turning people away because I do not have the capacity at the moment." He was saying, "How can I scale? Man, I'm getting business, but I can't really serve them." So speak to a broker before they get too busy. Another last question, sorry, last thing that I wanted to mention was, I also want to get your thoughts on what do you want to learn in the next webinar, and I can prepare some presentation and then also walk you through all the knowledge that I've built over time. This is just to give back to the community, make them as much informed as possible. So any topic that you want me to be covering in the next, so we will be running this webinar once per month. So let us know any other topics that come to your mind. Trust. Okay. I will be very, very careful because there are legal implications if I get into trust. I have to either get an accountant or it
Financial planner, maybe to give us more advice, something like this.
that is yes. So trust has
Yeah.
to be an accountant. I know what I've learned, or a broker. Broker can tell you again. Broker can tell you from the broking, like how trust works, but the broker again cannot tell you on the legal implications. How to pick a hotspot. Oh, yeah, interesting. How to pick a hotspot. So demand and supply data metrics, ideas, strategies on portfolio building. Okay. Yep. Okay. How to pick a hotspot. Yep. This is a good topic. How to pick a hotspot. So, Ma'am, if you can take a note of these topics and add to our list of topics that we have got internally, and then we'll prioritize and start doing sessions on them. Yeah. How to pick a hotspot and ideas, strategies on portfolio building. I've actually done one on them, and I think it is kind of an overlapping because how to be building a sustainable and sizable property portfolio. My webinar number one was on that. So there is a recording on my channel for that. And I think that is what should help here for this idea, strategies, and portfolio building. That tells you exactly what I did to go from 1 to 8. Yeah. Any other topic that comes to mind? Any leftover questions? Otherwise, we'll wrap it up. If nothing else, thanks a lot, guys. Thanks a lot for your time and patience. And for anything, feel free to reach out. This is our brand name. You can find us on Google, Instagram, Facebook, LinkedIn, wherever, on all the social media channels. And yeah, have a good night and wishing you a great financial success. Thank you.